if you own Apple stock, or Tesla, or a US index ETF, and if the total cost of your foreign investments ever crossed $100,000 in a non-registered account, the CRA has been waiting for a form you have probably never heard of. The form is called T1135. The penalty for not filing it is $2,500. The penalty for filing it late is $2,500. The penalty for filing it incorrectly is $2,500 every single year. And if the CRA decides the oversight was not a mistake, if they decide it was careless or deliberate, that penalty jumps to $500 per month, up to $12,000 per year. It does not matter that you already paid all your taxes. It does not matter that you reported every dividend and every capital gain correctly. The T1135 is a separate obligation, a foreign asset disclosure form that exists entirely outside your regular tax filing. The CRA has been issuing penalties for it with increasing frequency since 2015. Most Canadians who owe this form have never been told it exists, not by their bank, not by TurboTax, not by the financial advisor who recommended the US ETF. Welcome back to Maple Market Brief. Today we are talking about the T1135 Foreign Income Verification Statement, what triggers it, what it costs when you miss it, and the exact account combinations that put you inside this obligation right now without realizing it. Before we go further, let me tell you exactly who this video is for. If you hold US stocks, US ETFs, foreign bonds, or any non-Canadian security in a non-registered account, and the total cost of those holdings ever crossed $100,000 Canadian, you are inside the T1135 obligation. Not the current market value, the cost, what you paid for them. The CRA measures the threshold on original cost, not current value. Most coverage glosses over that detail. It is the detail that catches the most people. Now I want you to meet Kevin. He is 52 years old. He lives in Calgary. He works in energy project management and earns $115,000 annually. He has maxed his RRSP and TFSA every year for 12 years. 3 years ago, his financial advisor recommended U.S. equity exposure for diversification. Kevin bought $80,000 of a Vanguard U.S. total market ETF, then $30,000 of Apple shares over the next 18 months. His total cost in foreign holdings crossed $100,000 in March of last year. Kevin files his own taxes using TurboTax. He reported all his dividends correctly. He reported his capital gains correctly. He did everything the software walked him through. TurboTax did not ask him about T1135. His bank did not mention T1135. His financial advisor did not mention T1135. Kevin submitted his return in April, received a small refund, moved on. In November, Kevin received a CRA review letter. His foreign holdings had exceeded the $100,000 reporting threshold. He had failed to file Form T1135. The penalty assessed was $2,500. Not a bill for unpaid tax, a penalty for a missing form. On investments, he had already fully reported and fully paid tax on. Kevin paid his taxes correctly. Kevin paid $2,500 anyway. Drop a comment right now. Did you know the T1135 existed before this video? Yes or no? Because the answer is almost always the same. And if your answer is no, keep watching. Because the version of this story that costs $10,000 or more is coming in about 90 seconds. Kevin's situation is painful, but it is the minimum version of this penalty, $2,500 for one missed year. Now let me show you what happens when the oversight runs longer. The T1135 penalty is not a one-time charge. It compounds annually. Every tax year you held foreign assets above the threshold and did not file, that is a separate $2,500 penalty. Miss it for 4 years. The penalty exposure is $10,000. On investments, you paid full tax on every single year, without exception. And here's the detail that makes this worse. The CRA's normal reassessment window is 3 years. But for T1135 non-filers, the CRA gets an additional 3 years on top of that, up to 6 years of reassessment exposure. In serious cases, tax lawyers in Canada are now reporting T1135 audits reaching back more than 10 years. The window is not 4 years. The window is however far back the CRA decides to look. I want you to meet Patricia. She is 61 years old. She lives in Oakville. She retired 2 years ago from a senior marketing position. She has been managing her own portfolio since. Patricia built a substantial non-registered account over 20 years. Canadian dividend stocks, a US S&P 500 index ETF she has held since 2009. A small number of individual US technology positions from the pandemic years. Her total cost in foreign holdings has been above $100,000 since approximately 2016. Patricia used an accountant every year. Her accountant filed her returns correctly, every T5, every T3, every capital gain and foreign dividend, accurate and on time. Her accountant did not file T1135, not in 2016, not in 2017, not in any of the 6 years that followed, not because her accountant was negligent, but because T1135 is easy to overlook when foreign income is already being reported through other slips. The form is not automatically triggered by anything in the standard T1 return. Patricia's CRA review arrived 18 months ago. The assessment covered 4 years within the standard reassessment window. 4 years. $2,500 each, $10,000 in penalties, on investments that had been correctly reported and fully taxed for 2 decades. Patricia was not angry at her accountant. She was angry that nobody, not her bank, not her brokerage, not the platform that sold her the ETF, not any institution that processed her foreign investment activity every year, had ever once mentioned that a separate disclosure obligation existed. Here's the mechanism that makes this trap so easy to miss. The T1135 obligation does not live inside the tax return the way income reporting does. It is a standalone form filed alongside the return. But it is not part of the return itself. Standard tax software prompts you for income, deductions, and credits. It does not always prompt you for foreign asset disclosure, especially when your foreign income is already arriving through T5 and NR4 slips from a Canadian brokerage. A Canadian investor who buys a U.S. ETF through TD Direct Investing or Questrade receives Canadian tax slips for the income. The income reporting is handled automatically. The T1135 obligation is not triggered by that income reporting. It is triggered by the cost of the underlying foreign assets. The brokerage reports your income. Nobody reports your obligation to disclose. Those are 2 separate systems. They do not talk to each other. The CRA receives your income reporting through the slips. If your household income is under $60,000, the T1135 threshold is probably not an immediate concern. At this income level, maxing the TFSA is almost always the right priority for foreign equity exposure. U.S. index ETF inside a TFSA, no T1135 obligation regardless of value. If your foreign holdings are entirely inside registered accounts, you're outside the T1135 system entirely. The action at this level is to be deliberate about where foreign exposure lives. If you are building a non-registered account and adding U.S. positions, track your total foreign cost basis from the first dollar. The $100,000 threshold arrives faster than most people expect when a portfolio has been compounding for a decade. If your income is between $60,000 and $100,000, you are in the most common zone for this oversight. Many Canadians at this level have maxed their TFSA and RRSP and begun building a non-registered account with U.S. ETF exposure. 5 to 10 years of accumulation puts a significant number of people in this bracket inside or approaching the T1135 threshold without realizing it. The action right now, this week before the April filing deadline, is to open your non-registered brokerage account. Find the book value of every foreign holding, the adjusted cost base, not market value. Cost, add those numbers together. If the total exceeds $100,000 Canadian for any year since you first crossed that threshold, you owe a T1135 for that year. If you have been above the threshold for multiple years and have not been filing the form, the reassessment window means the CRA can reach back 6 years or more. Calculate your exposure. If more than 1 year is missing, speak with a tax professional about a voluntary disclosure before the CRA identifies the gap independently. A voluntary disclosure eliminates or substantially reduces penalties. Waiting for a CRA review letter eliminates that option. If your income is above $100,000, the T1135 obligation almost certainly already applies to your non-registered portfolio. The penalty risk is highest at this income level because the portfolios are largest and the time horizon is longest. And because the CRA is most likely to characterize a long-running non-filing as gross negligence rather than a simple oversight, that characterization matters. Because gross negligence does not trigger a $2,500 penalty. It triggers $500 per month, up to $12,000 per year. Investors in this bracket who have held substantial foreign positions in non-registered accounts for a decade or more face potentially significant penalty exposure, depending on how the CRA assesses the nature of the oversight. The action at this level is an immediate review of your T1135 filing history with your accountant. Confirm that T1135 was filed for every tax year in which your foreign non-registered holdings exceeded $100,000 in cost. If any year is missing, do not wait for CRA correspondence. File a voluntary disclosure through the CRA Taxpayer Relief Program. That process exists specifically for situations like Patricia's. Not fraud, not evasion, a genuine administrative gap in a correctly reported tax history. Here is the honest picture for 2026. The CRA has been increasing T1135 enforcement since 2015. That year, the CRA received new international data sharing infrastructure through the Common Reporting Standard. Foreign financial institutions now report Canadian account holders directly to the CRA. The CRA does not need to audit you to know you hold foreign assets. It receives that information automatically. the gap between what the CRA knows about your foreign holdings and what you have disclosed on your T1135, is a gap the CRA is systematically closing. Every year that gap stays open, the exposure grows. Every year, the CRA's data gets more complete. And every year, the argument that you simply did not know the form existed becomes harder to make. 3 actions before the end of this week. First, open your non-registered brokerage account and identify every foreign holding by cost basis, not market value. Cost. Add them together. If the total is above $100,000 Canadian for any year since you first crossed that threshold, you have a T1135 obligation for that year. Second, check your past tax returns and confirm whether T1135 was filed for each applicable year. It is a separate form. It will appear as a distinct document if it was filed. If you cannot find it, it was not filed. Third, if any year is missing, contact a tax professional before April and ask specifically about the CRA Voluntary Disclosure Program. That conversation costs a few $100s. Not having it can cost far more. The form is 2 pages. Filing takes less than 30 minutes once you have your numbers. The basic penalty for not filing is $2,500 a year. On investments you already paid full tax on. If the CRA decides the oversight was careless, that number becomes $12,000 per year. Kevin did not know the form existed. Patricia's accountant overlooked it for 6 years. The institution that sold both of them their US ETFs never mentioned it. The brokerage gets paid when you buy. The CRA gets paid when you miss the form. Your job is to know the form exists before the letter arrives. Subscribe to Maple Market Brief and tell me in the comments. Did you know T1135 existed before today? And if you hold US stocks or ETFs in a non-registered account right now, drop the word checking below. That means you are opening your brokerage account and running the numbers right now. That comment tells me this video did its job. The next video in this series covers the moment your non-registered account, your RREF mandatory withdrawals, and your CPP timing decision all converge into a single calculation, and why getting one of them wrong undoes everything the others were designed to protect. That one is coming next.